Welcome back to the program. I'm Zev Brenner. Welcome to another Lumi Financial Corner. With us once again is Michael Zaremski, head of U.S. Private Banking, Bank Leumi USA, member of Investment Committee for Lumi Investment Services. Welcome back to the program, and good to speak with you again, and happy Hanukkah.
Thank you very much, Zev. Great to speak with you, and happy Hanukkah to you and your listeners.
Now, tell me, Michael, when I watch or read reports about what's going on in the market and the prognosis, some people are very optimistic, some people are pessimistic. Everybody's looking at the same data. Why such a divergence of opinions?
It's a great question, Zev. And the conclusion that I come to is that in some cases, some people look at the world or the data as half full, and some people look at the data or the information as half empty. And I think that that's a real challenge in terms of, really determining what do the numbers mean. So when we look at all sorts of numbers, and I'll give you a couple of examples, we can look at the numbers or the economic data in an absolute, or we can look at it relative. And I think it's very important to build context around the numbers to really determine what direction we're heading and what the expectations are. Before I give you specific examples of what I'm talking about, I just want to reiterate that the opinions expressed are mine, not necessarily those of the bank. So when we do look at some actual raw data and some numbers, I think unemployment's a great example. If we look at an unemployment rate of 6.7%, which is what the current headline number is, I think most people would look at that and say it's a bad number. But when you say it's a bad number, I think, again, you have to build some context into it. It's November right now for the data, but if we look back at April when it was 14.7, we've come back down a long way, and by all indications, the unemployment rate is going to continue to get better. So is the glass half full or the glass half empty? I would assume that the glass is half full, particularly when you think about how many places are still in lockdown, how many businesses are still shut, but yet how much improvement we've seen on the unemployment data. I'll give another example of GDP. When we look at GDP for the year, it's likely to be about a negative number, which again, in an absolute context, is a really bad year. But given everything that's happened, first quarter GDP was negative 5, second quarter GDP was roughly negative 30. We saw a 33% bounce in Q3, and by all expectations or indications, we should see somewhere between 5 to 12%, which is a wide range, but pretty significant GDP growth in Q4. When all's said and done, it's going to be a pretty good GDP year relative to what happened, and in many ways we're going to have exceeded expectations. So again, when you think about how many parts of the economy or how many different businesses and small businesses are locked down and closed or temporarily shuttered, and you think about how far we've climbed in GDP, I look at it as a glass half full story where we can be optimistic about where the future goes from here.
But logically speaking, you're correct, is that we had some setbacks due to corona, but things seem to be moving on track, and the fact that we're also, as you said in previous broadcasts, a technology-oriented society, which also helps with the traditional factors may not play as much of a role as they have in years past. So I think overall, I believe you're bullish about the future.
Absolutely, and I continue to remain bullish in a lot of ways because, as we've talked about before, the market is a forward-looking indicator. The market is not pricing what's going to happen in January or February. The market's really pricing what's going to be happening kind of 3 to 6 months out. So if there's a little bit of a stumble with one of the vaccines or two of the vaccines or something takes a little bit longer, the market's going to look through most of that. But what we do still see with the market, and again, this goes to the glass half full, glass half empty story, when we look at liquidity, for example, there is so much cash that's still sitting in money market funds. There's so much cash that's in allocation strategies in these cash designation buckets. In fact, the last time that the cash build was as high as it is now is in 2007, 2008. And it does make sense that the cash build is as high, and people, again, the glass half empty would say people are very concerned and they want to hold on to their cash. The glass half full would say that ultimately this cash is going to find its way into the market, whether the bond market, the equity market, or other investment or capital, generation ideas. So people will eventually deploy this capital as they get more comfortable. And again, from the glass half full side of it, we're starting to see more and more signs of it. So as this liquidity build starts to deploy into the markets, we could see a whole nother huge leg of investment as we go into next year. I'll also make one other comment on PE rates. One of the topics that we see right now is as the equity markets have really risen, we're seeing a lot of concerns about PE multiples. Are stocks too expensive? So on the first hand, making a broad statement about the stock market through one ratio is a bit naive. But I think even when you look at different pockets of where we do actually see stocks or industries or sectors that are expensive, I think the other question begs, what does an expensive price-to-earnings ratio mean? And in many ways, again, from the glass half full, if you buy companies that are expensive, but they're expensive because there's an anticipation that the earnings will follow, then typically these are the early cyclical companies that really could benefit from continued economic growth and recovery. And then also, we've never really had an environment where interest rates have been so low for so long. So while the stocks are expensive, in many ways the stocks are expensive because there's really not much else to do and people want to own growth. So again, if you think about supply and demand, when something is in short supply, there's a high demand for it, and that drives up prices. So the reason why people keep bidding for growth stocks is because growth is a limited commodity right now. It's difficult to find, and the pockets where you can find it, people are looking for those avenues and those opportunities. So my expectation is that we will continue to see these movements and continue to see these trends. And, again, this is the glass half full scenario of, things are going to get better, things are in a good place. And again, as we look through the forward-looking mechanism of the market, anticipation is that we should be in for another good run or another good year for 2021.
And with God's help, it will be. There'll be a nice Hanukkah gift and it'll be a nice holiday gift. So, and I think things will, God willing, get better now that there's a corona cure. There's a vaccine out there. I think that's going to make a very big difference in the confidence that people have.
Yes, so, I would say that the vaccine would be some of the best presents that many of our, much of the population could be asking for.
Michael Zaremski, head of U.S. Private Banking, Bank Leumi USA, member of Investment Committee for Leumi Investment Services. Thank you for being here with us. And happy Hanukkah to you and your family.
Have a great day.
Okay, thank you. We're going to be right back. Don't go away. Stay tuned.